welcome to the Explainer. Today, we're going to pull back the curtain on the secret language that every single business speaks. You know, every single business out there has a story. Think about it. Your local coffee shop, that huge tech company everyone talks about, they all have a story. But it's not the kind you read in a book.
Nope, this story is written in numbers. And today, we're going to learn how to speak that language. We're talking about bookkeeping, or as they call it in Japan, bookie. Ready? Let's dive in.
All right, first up, the two-sided story, also known as the duality principle. Now, if you remember just one thing from this entire explainer, make it this. Every single story, every transaction in business has two sides. Always. No exceptions.
So what are these two sides? Well, we call them debit, or karikata, and credit, or kashikata. Think of it like this. A debit is what the business gained, and a credit is what the business gave away. The golden rule, they have to be equal, every single time. It's like the fundamental law of physics for business, perfectly balanced.
Okay, let's move on to the core of it all, selling and buying. Let's see this whole two-sided thing in action with the most basic stuff any business does, right? You buy things and you sell things.
So let's say you're a business and you buy 10,000 yen worth of inventory. What happens? Well, you gained inventory, which is an asset, so that's a debit. And at the exact same time, you gave away cash, which is also an asset. That's your credit. See? 10,000 in, 10,000 out. It's perfectly balanced.
Okay, but what happens if you sell something and your customer says, hey, I'll pay you next week? Well, you didn't get cash, but you did gain something valuable, a promise of future payment. That promise is actually an asset, and we call it accounts receivable or urekakekin. So that's our debit. And what did you give away? You gave them a product, which means you made a sale. That's your credit. And you guessed it, this works the other way around too. Let's say you buy inventory, but you're the one promising to pay later. You still gained the inventory, so that's your debit. But what did you give? You gave a promise to pay. This creates a debt, a liability, and we call that accounts payable or kaikakekin. That becomes your credit.
So you can see how these two things are perfect opposites, right? Orikakekin, accounts receivable, that's an asset. It's money someone owes you. But kaikakekin, accounts payable, that's a liability. It's money you owe to someone else. One is a promise you received, the other is a promise you made.
All right, we've got buying and selling down, so let's talk about the lifeblood of any company, the flow of cash and payments.
You know, even something you do every day, like depositing cash at the bank, tells a two-sided story. The business gains money in its bank account, that's a debit, and it gives up the physical cash it had in its drawer, that's the credit. It's like pouring water from one glass to another. The total amount of water doesn't change, it's just in a different container. Now, in Japan, and a lot of other places, checks or kogite are a really common way for businesses to pay each other. They might look a bit formal and old school, but the rule for how you record them is surprisingly straightforward. The process is pretty much what you'd expect. Someone with a special kind of business checking account, a tosayokin, writes you a check. You get it, you take it to the bank, and you get your cash. Simple enough. But the real question is, how does this get written into our business's story? And here's the cool part, the key takeaway. When you receive a check from someone else, you treat it just like it's cash. It's considered an immediate asset. But when you write a check, the money is recorded as coming out of that special checking account, the tosayokin. It's a small difference, but it's super important for tracking exactly where your money is. Next up, let's talk about the engine of the business, its assets and expenses. See, a business has to spend money to make money, but how it records that spending is a huge deal. It all comes down to what you're buying. This leads us to a really, really important fork in the road. Is something an expense or an asset? An expense is something you use up pretty fast. Think office supplies or gas for the company car. An asset, on the other hand, is something that's going to provide value for a long time, like the car itself or a building. And trust me, this isn't just semantics. It totally changes how healthy a company looks. Expenses hit your profits right away, while assets make the company look more valuable over the long haul. Let's take a car inspection in Japan, the Shaken, as an example. Look at this. The repairs, the taxes, the insurance, they're all listed out as separate expenses. Why? Because that value is used up right now. It's gone, and that means it hits your profit for this month immediately. The books are showing the day-to-day cost of just keeping that car running. But now, look at what happens when you buy the car itself. It's a totally different story.
The price of the car, the taxes, all the little fees to get it on the road, they all get bundled together into one big entry. It's a debit to a single asset account called vehicles, or shario unpanku. And that's because that car is going to be useful for years to come. It's not an immediate hit to your profit. Instead, the story your books are telling is, hey, we just got stronger. We now own this valuable thing.
Okay, last part. A story is only good if it's true, right? So let's talk about keeping the books clean, all about controls and corrections. What do you do to make sure the numbers are right? And more importantly, what do you do when you find a mistake? For all those little cash purchases, coffee, stamps, whatever, a lot of companies use something called the imprest system. It's actually pretty smart. You start with a fixed amount of petty cash, let's say 50,000 yen. People spend it and bring back receipts. Then, to get the cash box back up to 50,000, you have to add up all those receipts and put that exact amount back in. It forces you to check where every yen went. It's a great little system for control. But we all know things go wrong. A receipt gets lost, someone miscounts. So what happens when you add up the cash and the receipts and, whoops, the numbers don't match? Is the whole story ruined? No, not at all. Here's what you do. Step 1, you record everything you do know. You've got receipts for travel and supplies, so you book those. Then, that mystery amount, that 1,000 yen that's missing, you stick it in a temporary account. It's literally called cash over/short, or genkin kafusoku. This is like a placeholder that lets you balance the books while you figure out what happened. And then, step 2, you fix it. You do some digging and you find out an employee just forgot to turn in a receipt for a travel expense. So you make a simple correcting entry. You move that 1,000 yen from the temporary cash over/short account to the proper travel expense account. And just like that, balance is restored, the story is accurate again. So you see, bookkeeping, bookie, it's not just about crunching numbers. It's a language. It's about telling a story that's precise, that's balanced, and that's true. It's a story of what you gain and what you give, of long-term assets and short-term costs, of promises you make and promises you keep. And now that you know the basics of this language, you'll start seeing those stories playing out everywhere you look.